We mentioned just a minute ago that your note over the weekend, you said it was your first cautious one in several months, but put some context around that. I know you still think that the stock market might be able to kind of reclaim its losses for the year, but what gives you a bit of pause in the near term?
Sure. To begin with, with the context, Mike, that you referenced, I do think we've hit the twin peaks. We hit peak inflation. The market expectations of that actually peaked in April. But the numbers, goods prices, energy prices have clearly peaked. We also hit peak hawkishness or peak tightening expectations. It's not when the Fed actually pivots. If we consider 94 as a great example of this, the Fed's peak hawkishness point was when they hiked 75 basis points back in November of 94. They didn't actually pivot till June. That was the inflection point for the markets. Waiting for the pivot is too long. However, I do think we're in a position for an aftershock of what I've been describing as the mother of all taper tantrums. I would describe what happened in the first half of the year probably more as a Fed policy correction, but we could think of it as a taper tantrum, and it was related to the tightening of liquidity. The reason I think we're set up for an aftershock here is there's three channels that QE and QT affect the markets through. There's liquidity and reserves. We had a real shock in the first 4 months of the year due to the actions of the Treasury, even more so than the Fed. So I'm really not concerned about the Fed draining $60 billion of liquidity a month through maturing Treasuries. Then there's that portfolio balance channel, the Fed buying Treasuries and forcing people into riskier asset classes. The taper tantrum is the QT side of that equation, right? The portfolio balance effect. But the final piece is the setting and level of long-term rates. And 5 and 10-year real rates, that's the non-inflationary portion, are still far too low. And we went from negative 110 basis points on 10-year real rates to plus 80, and then backed all the way up to 30. I think they're vulnerable here to a move higher, partially because of seasonality, and partially because I do think the Fed could start talking about selling mortgages. And that piece is the only part of the QT story that really isn't adequately priced. So if you think back to September of 2018, for example, you started to move those real rates higher, and the markets reacted to that. The same thing happened in January of 18. So I don't think we'll get back to the lows or close to it, but I am concerned that this move higher in rates, the real rate portion of it in particular, could cause a broader risk-off event.